Hey guys, good afternoon, everybody. This is a private one-on-one mentoring session with Marion. I'm going to set up this room real quick and then I'll invite Marion over so that we can start with our session. So since this is a private one-on-one session, I'm not going to be answering any questions from the chat. But you guys are free to sit in on this mentoring session and grab whatever advice and information you may want or may not have known that you wanted from this meeting with Marion. So I'm going to set this up real quick and then we'll get started shortly. All right, looks good. Let's let this finish loading. So I'll get this link sent out over here. Perfect. So I'll get this link sent out to Marion. All right, now I just wait. Pull it in sometime soon. Hey, Marion, can you hear me? Just want to make sure the mic's working and everything.
Yes,
Um,
I can.
oh, perfect. How's it going?
Very well, thank you.
That's great. Awesome. It's glad to hear. Hey, nice to finally meet you.
Yes.
Yeah, no, definitely.
So,
Okay, so basically the way that these meetings work, it'll be tailored to you. So depending on like where you're struggling, where you need help with, we'll go from there. So if you have any questions, if there's any issues you have with the platform, anything like that, we can start from there. Because I'm not sure exactly where you're at. So I'm not sure like what level you're at right now. If you're like very, very basic beginner, if you're starting to pick up on things, or if you're already, advanced to like the strategies, we can just tailor this to where you're at, build a foundation, and then from there we can build on.
okay. So when you said I could ask questions, I went back to a book where I write questions as I'm going along.
Yeah.
And I discovered that a lot of things I had problems with, I actually now understand, but I still have some problems with a few things. And they're very basic, but they're very fundamental.
Yeah.
And if I feel that once I understand these really, really basic things, I would understand so much more. So I've gotten to the point where I can actually take trades now, and I understand some of the like hold on just a second. I understand the BV3. I understand the B1 pattern. I understand there. So some of the strategies that you use. I understand them. I understand the what's it called? The lines, the green and the red lines. Just a second.
Yeah, no worries. It's a lot of information for you, but I see that you're starting to put
The
the pieces.
momentum. Yes, I understand the momentum indicators. I understand all of them. I understand the pivots. I understand the indicators. I understand the one at the bottom. I think it's called the trend
meter.
the trend meter. Yes, I understand all of that. And there was once when I went on YouTube and I watched one of your videos, one of your live sessions. I didn't understand anything. But now when I joined the live sessions, I actually understand quite a lot. But there, like I said, there's some fundamental things that I'm not very clear. And I think maybe you can help me with those for starters.
Oh, definitely. Yeah. Yeah. We can knock out the questions. So whatever questions you have, if you have a list, we can go over those one by one.
Okay. Yes, I do have the list. So this may sound really basic, but I just need a very good grasp of it. So I need to understand what pips are, lot sizes, and leverage.
Okay.
So I have a fair idea, but I think it's a little too basic. I need a little bit more explanation from you, if you don't mind.
Yeah, no, definitely. Let me see if I can the text button here. So I'll just make a list of, okay, so let's see. So the topics you wanted to cover were, so let's put topics here for now. So you wanted to review pips.
Okay, so module 5, I didn't understand module 5 in the so that was the one on pips, lot size, leverage. And then should I just tell you all the questions, and then because some of them might be related and we can do them together, or should we go through them one by one?
It's up to you. If you want to just put them all together, we can make a list here with the topics and then I can go over them like one by one. I know like a lot of these terms are no longer used because we've moved from Forex currencies to now futures. They're the same, they're very similar, but it's just the measuring is slightly different. So I do realize that those videos, they're not necessarily going to make sense because now we're on futures. But once you understand ipses versus points, it's very simple. So I'll distinguish the difference so that you can understand in the future if you decide to trade, currencies or anything like that. But it's not very difficult. So if you want to make a, we can do that. Otherwise, if you want to just take these, by bits and pieces, we can do that as well. It's up to you. However.
Okay, so I think I'll just start with the pips, the lot size, and the leverage first.
Okay, perfect. Yeah, no, that's great. So, okay, so pips, when you're trading, so previously to futures, there is another asset called indices. I'm not sure if you're familiar with what indices are. They're basically like a mirror asset of futures. Futures are the real asset. So what we're trading now is the real asset. This is the asset that comes from the exchange. So when you trade futures, the asset that's actually traded in the Chicago Mercantile Exchange, which is very similar to the New York Stock Exchange, but just for futures. When we trade pips, we were trading indices, which are a mirror. It's the same thing. It's a mirror of the same asset, but they trade them in tenths. Tenths, so like the number 10. So basically a pip would be equivalent, like 10 pips will be equivalent to 1 point. And that we're using. So basically what you're doing is you're just using the whole number instead of a tenth. So for example, if we were going for 1,000 pips, that's equivalent to 100 points. So you're just cutting off, it's just a tenth of it. But now that we're all numbers, and I can show you here on the chart too. So let me pull up 2 separate charts next to each other. Let me just take everything off here. So what we're trading now is YM, which is a future. The indice, which would be US 30. So if you were to look at these side by side, you'll see that, let me just take this symbol off here. So you'll see if you're trading the future, it's a whole number. It's at 39,246. If you look over here on the indice, the price is going to be at 38,777, but with a decimal after it. So that's why the pips mean points and percentage. So instead of points, it's just a percentage of the point. Um,
Okay.
so it's a very simple concept, but a lot of people aren't too keen on what it means, especially if
Okay.
you're moving from one to the other. But the pips, you don't really need to know about that as much because now we're using whole numbers. Pips are actually more complicated because you have a decimal point and you have to realize more numbers. But with points, you're just going by the actual point, not a percentage of it.
I see. Okay. There was in one of the videos I watched, it said that you risk 300 pips per trade, but if it's for breakout 2.0 trade, then you can risk 1,000 to 1,500 pips.
Yeah. So with those strategies, you would vary. So if you want to compare the pips to the points, so how we said it was 1,000, you would have 100 points. So instead of 1,000,
Okay.
it'd be 100 points. And the main difference between those two, or that main concept, is where you have a range between 1,000 or 1,500 because of the movement of price. So if you wanted to use that with regard to futures, how we're trading now, you would just cut off the zero. So instead of 1,000, you go for 100. Instead of 1,500, you go for 150 points.
Okay. So why would anybody prefer to trade futures than forex?
So
What's
futures, oh, okay.
Yeah.
So the futures is you're trading directly with the exchange. So like when you're trading the futures here, this is all real data. So this is the data that's coming from the exchange. When you
I
trade
see.
Forex, this data is made up. So say, for example, you want to create your own price for futures. Futures, like say, for example, I'm going to try to find it a bit. Okay, so say, for example, you're from the UK, right? So you guys use pounds. So you
Yes.
go to the bank and you want to, and the bank is exchanging pounds, right? But what you want to do is you want to make pound M. So you're going to make your own pound under Marion. You're going to have your own pound. That's Forex. So Forex isn't the real number. You're creating your own number. So the reason why a lot of people trade Forex is because it's there's more leverage. It's an unregulated market.
Okay.
So with the futures here, there's more regulation because you're trading with the US market, it's regulated. You're trading with the actual exchange and their actual pricing. With the Forex market, not all Forex markets, some Forex markets are regulated, but majority of them are unregulated. So
Okay.
if you want to trade futures, typically you would have to have an X amount of money. You'd have to have like at least, $1,000 to $5,000 to trade, right? When you go
Okay.
to the Forex market, you can trade with like a percentage of that. You can trade with $100 because you're trading in percentages now. You're not trading the full future, the full point, but you're trading a portion of the point. So the reason why a lot of people traded Forex were not just Forex, but indices. So Forex and indices fall within the same category. People would trade
Okay.
that because they have enough money to trade on the actual exchange.
I
But then,
see.
but the problem with that is that scammers go into that side, because it's unregulated. So when you trade with a lot of these Forex brokers that are unregulated, you can deposit your money into this broker and the market will work against you because they can
Hmm.
create the price difference because they're creating the price. It's their own market, right? They can set whatever price they want. They can set whatever spread they want. So what happens is sometimes you'll be in a trade, and if someone is trading the futures, they'll be out of the position. Like for example, you enter a position, hit your profit target, you're out. What happens with these Forex brokers is they make the spread so wide that it's almost impossible to get out. So the person on the futures market will be out because they're trading real price, but the other person who's trading on the Forex market, they're still stuck in the position. They're like, oh, why am I still here? Everybody's out, right? Because their
Yeah.
broker sets their own rules.
I
So
see.
so it's
Okay.
so you're basically getting a discounted rate to trade with an unregulated broker, but then you run the risk of getting trapped in a position, being unable to withdraw your money because they have your money, but they're not regulated by the US, they're not regulated by any by the European Union and stuff like that. So like
Yeah.
he's kind of in the Bahamas somewhere, in some island where where you have no control over it.
Okay.
You're trading futures, you're trading with a broker or a company that's like regulated along the US. So they can't scam you. If they don't give you your money back, you report them to the regulators and you'll find your way to get your money back. So that's the main difference. So yeah,
Okay.
that's why I wanted to start with the Forex market because initially there was no funding companies and there was no ability to trade unless you have a big sum of money. But now
Okay.
there's different avenues where you can trade with funding companies or you can trade with your own money or you can find different outlets where you can trade with them, but also not have the full amount of trade.
Okay. All
Yeah.
right. So thank you for that. Okay. Now this one is another one that is very basic, and I thought I knew what it was, but
Mhm.
when I was watching one of the videos, something that I thought should have been a lower low was actually a higher low. So I realized that I need a little help with lower low, higher low, and sorry, lower low and lower high, and higher high and higher low. So the way I saw it was that when the market is trending up, when there's a peak somewhere, that's a higher high. And when it comes down before it reverses and goes back up, that's a higher low because it's trending up. But when it's trending down and there's a high, then it's a lower high. And and then when there's a low, it's a lower low. So that's the way I thought it was. But I saw a video, and what I thought should have been a lower low was a higher low. And so I realized that I was a bit confused
Mhm.
with
Yeah,
that.
it's so depending on when you're looking at the market, lately the market hasn't been very trending. It's kind of been
Okay.
so it's a lot more confusing unless you have my high-low indicator. The high-low indicator kind of like takes out the guesswork, and that's probably where it kind of corrected you or you were watching, like how people identify it. Because typically, like for example here, like I don't have the indicator on, but for something like this, like say for example, this right here is the high, right? Like we'll just use this as an example, as this being the high. And when price comes down, this would be the low, and this would be a lower high, right? Because it's a high, low, high, lower high, because it's still a high, but it's lower than the previous high.
I
And
see. Okay.
the only time it would change is if it goes the other way. So for example, let me see if I could. Okay, so I'll just use this right here. So we'll just say this is the high. Like we'll just say, for example, this is where the high starts. And then we'll say that this right here is the low. And this goes along with what you were saying, like, this is a high, this is a low. And then once it drops lower, this will be considered a lower high since this can't be a higher high because in order for it to be a higher high, this would have to be above this high here, right?
Okay. Mhm.
So if this was up here, like if this was to push up higher, then in this situation, this would be considered a higher high. Because you're basically just looking to break structure. So we'll
Okay.
just keep moving along right here. So say, for example, and we'll use another example down here. So now we'll say that we'll say, for example, this is the high right here. So we'll say this is the high. And we'll just say, for example, this is a low.
Okay.
So we'll just use this here as a low. Um, and then price begins to climb up higher. So initially starts here high, low. This right here would be considered a lower high. And then this is where it starts to shift. So this would be a lower high, price comes back right here. Now this is a higher low.
So that is where I got confused.
Oh, where it starts to shift. Yeah. So when it starts to shift like that, because you have a high, low, this is a lower high because it's not higher than this high. And this right here
Okay.
will be a higher low because it's shifting. Because now this low is higher than this low right here.
Ah, I see. Okay. Now I understand. Okay.
And then
So
now,
basically, it's just whether it's higher or lower than the previous low. So if it's higher than the previous low, then it's a higher low.
exactly. Yeah. It's pretty simple.
Okay.
It's hard to see unless you actually like look at it, right? Because when it's moving so fast, like when you're watching it live, it's adjusting quickly, like it's adjusting
Yes.
the other candle. Um,
Yeah.
that's why we typically wait for the high lows to kind of establish. Like typically, if you wait
Okay.
a few candles, like maybe 4 or 5 minutes after the high or the low has been established, you're going to identify the next one. So, like for example, here this is a lower high, and then now you can see how this high right here is now the higher high, right? Because you go from the lower high here and it pushes up, and now this is the higher high. And then from
Okay.
now you get a higher low again because it's higher than this previous low. And then
Okay.
it continues higher. So now at this point,
Yeah.
going higher, higher, and higher. So it's
I
pretty simple.
see.
It's a simple concept, but like unless you actually see it in action, it's kind of hard to see. That's why I created the indicator, the high-low indicator, because it does a job for you. And it does it quicker and more accurate because the algorithm is always adjusting as price is moving along instead of you having to guess, okay, where's the higher high, where's the lower low? Yeah.
Okay. Okay. I took okay, that's fine. You know, I'm trying to get to the point where I understand everything even without the indicators. But
Oh,
right now, with the indicators, I understand what you're doing. So when, like today, during the live trade, I was actually able to follow what you were doing because
mhm.
all the indicators were there. But if I saw a screen like this one and there were no indicators, then I need to understand like when to take my trades, when it's a lower high, when it's a higher high. So I'm just trying to get everything really clear in my head,
Oh,
you know,
exactly.
so that, yes,
Yeah, yeah, you should always understand the logic. The indicators are meant to just make things easier so you don't have to, because the market's moving so fast, you're not able to
yeah,
high, low every couple minutes.
yeah,
Especially if you're trading on the 1 minute. If you're trading on something that's like a higher time frame, like say like even the 10 minute, 20 minute, 30 minute, something higher than the 1 minute, you can do it yourself by
mm,
hand. But on the 1 minute, it's happening so quickly, unless you're able to
yeah,
identify investments, it's going to be almost impossible, especially if you're trading
yeah,
at this pace and this speed.
yeah.
Yeah.
Okay, so that's that. Thank you. Then, okay, so with the TPs and the stop losses, I noticed that for certain types of trades, you might use 300, 100, 300. And
Yes.
for some, you might use 300, 300. And there was a video I watched where you said because you were not, you basically the stop loss and the take profit changes depending on the trade you're doing. So I wondered, how do you determine what stop loss and what's take profit to? I also noticed that your take profit is actually quite conservative. You take your profit very quickly.
Mm-hmm.
And I don't know whether that is because you have, because I've also heard you say that you have more several trades going on simultaneously. So maybe if you have a profit of 1,000, but because you have 5 trades going on, then you have 5,000 at the end of the day. But I'm just wondering that for somebody like myself, who I have just one trade going on, would you say that I can take a slightly higher profit, or I should still stick to the conservative profits? The lower,
Yeah.
just yeah, because I think you use the word scalping. So
Mm-hmm.
because if they're very quick trades, I don't know whether that is why you take very quick profits, even though they're not large profits. They're quite small, but they're very quick.
Yeah,
So
yeah.
how yeah,
Yeah, so those strategies are different. So the ones that are 1030, like you mentioned, that are quicker scalps, those have a higher probability of winning, and those come up more often. So for those types of
okay,
strategies, you may see the entry come up, or multiple entries come up, 5 or 10 times during the live session. So like with
okay,
those types of entries, you're going to be more selective. You're not going to take every single entry, but if it lines up and there's no red flags and there's no caution around those entry points, then you can take multiple entries and then they'll add up. the difference between the 1030s and the regular scalps versus the one-to-one, like the breakouts that we're taking, those entries only come up like once a day. So they come up once a day and they're less probable, like the probability is a lot lower, but you have a higher risk. You have a bigger range, so you can make more profit. So you kind of have to make a choice. Um, for me, sometimes I go through different phases. Like sometimes because you can make a lot more money through like scalping the 1030s. So the reason why you do the 1030s is because they have such a high win rate. Like if you've seen from the previous results from like last year or even in January, these are all like the smaller scalps. So you can see we had like about 14 wins. Our win-loss ratio was 93%. So we only lost one trade for the entire month. But like you said, these are small scalps so that you can win a lot more trades here compared to February, we had a lower win rate, but we only took the trades that go for a one-to-one risk reward, 25-25. And you can see here the profit is about the same. So it just kind of depends on the person who wants to trade. Some people want to trade something where you want more entries, and it depends on the person. Like everybody's personality with trading is slightly different. Sometimes you want to take a lot of trades, sometimes you want to take just one trade per day. And it'll make a difference with your profitability. So if you look at the results from 2023, you can see basically all of last year, we were doing all of the quick scalps. So you can see we have a very high win-loss ratio. We maybe lose like once a month, like once or twice a month. But these are all smaller trades. So it just kind of depends on the person. So like for you specifically, you'd have to determine, do you want to take multiple trades a day or do you want to take one trade a day, right? If you want to take one trade a day, you can take bigger risks. Like for me, I take my full risk on just one trade. When I'm taking multiple trades and going for the smaller profits, I lower my risk so I can split up my trades throughout the day. So I can, if I'm taking the smaller trades, I'll probably risk where I can lose maybe 2 or 3 times a day. And then it'll be the same risk, the same loss as if I just took that one trade with the same amount of risk. So now I'm only doing one trade. The reason why I'm doing one trade is because it's just the problem with the majority of people in the group, why they are not successful or they're not consistent, is that they get greedy, right? Because if you're taking 2 or 3 trades a day, you're like, okay, this is easy. Why am I not taking 5, 10 trades a day? So they'll make their wins and then they get greedy and then they just lose everything. So the reason why I switched to this more conservative way of trading where it's just one trade but normal risk is to show people that you don't have to take 10, 20 trades, right? You can take one trade with a high risk, but a good percentage of winning, and you can still be very profitable. So, and it's been easier for me too, because now it's easier for me to just focus on one strategy versus looking at, 5 or 6 strategies, because that's like one thing that people would get confused with too, is because not everyone is up to par. Like for example, for you, you don't know all of the strategies. So, some people are calling pivot scalps, some people are calling momentum scalps, high-low momentum scalps, high-low scalps, triple confluence, B1 variation, B2, B3. That's like 8 strategies already. But for someone like you who's just joining the live sessions, this is like a new language to you. So that's why I'm sticking to just one strategy so that I can show people that if you want to just take one entry or one type of strategy, you can be fine. But in the future, once you become more, more professional with trading, then you can start to apply others. So you can see other people's profits. Like there's, we have our admin group here, and you can see that their profits are a lot higher because they're doing multiple strategies, not just one. So I posted a couple of the profits from our admins here. So these are all of our admins. Like CT is one of our oldest members. He's an admin here. He made 2,000 per account because he took 3 trades. Kip here made 4,000 per account because he took 6 trades. They're doing the smaller scalps, and they're also taking the same breakout that I'm doing. But these are the more avid traders that are familiar with trading that type of style. But it just depends on the person. So for you personally, I would recommend that you just stick to one strategy. It can be one of the quicker scalps or it can be the breakout. But then once you get good at that, then you can start building on that. And then you can add more scalps to your arsenal, and then you'll be a lot better off catching more profits and controlling your risk properly. But that's the main thing. It's all based off preference. There's no right or wrong way to do it.
Okay, so far with my demo accounts, the strategy that I find works almost all the time is the the breakout, the one that you look for the higher high, and then if there's a double, if the candles are like reverse candles, so if there's a green and a red candle, and then the momentum indicator. So for example, if there was a buy indicator and then a sell indicator, then if the higher high had two, I'm still trying to get used to the words that you use. If the candles were like a buy and a sell candle, the double candle and the double wick, or the double wick, and then there's a strategy you gave that if the next candle is a sell candle and also has a sell momentum, but it also has a sell candle within the sell momentum, and the next candle is also a sell candle, then we can take a position there to trade. I find out that has worked almost all the time. Would you say that is the most reliable strategy? I think you call it the, sorry, just a second. I think you call it the BV3.
Breakout V3. Yeah, so yeah, that's one of my favorites. That's the only strategy that I'm doing right now.
Yes.
I'm only taking the breakout, but you can also take it as a continuous strategy. So there's also BV3, which is the breakout V3, or you can take the breakout V3 continuation. So those are the differences between those two. It's the same thing, but different, because with the BV3, it's a once-a-day strategy. So for that one, that's where you take a bigger risk. Well, not bigger risk, but you take your full risk on it if you want to just take one trade. That's a 25-25. So that's the same entry that we took today. So if I rewind here to, I believe it was around 8 o'clock. So the entry we took today during the live session was right here. The pattern isn't on, or no, actually it was quite a bit forward.
When you say take a bigger risk, do you mean a larger lot size?
Yes, large. Lot size when regards to indices, or contract size with regard to futures. So yeah, this over here is not a clean pattern because the market today, I don't know, were you on the live session today or not today?
Yes.
Okay, so you saw that the data was a little different. So we were kind of running side by side with the other symbol, which is basically the same thing. This happens like maybe like 4 times a year because the contract will shift over and the volatility is a little different. You're not going to see the double body right here, but there was a double body at this point, double body rejection. And this was the entry that we took here. So yeah, this is an example of like what you mentioned, where you have the double body and then it's followed by a green momentum and a green candle after. So this can be taken in 2 different ways. This can be taken as a breakout V3, which is what we took today. And the risk with that would have been at, it would be 25-25. So for this here, I'm typically risking 10 contracts. So where I'm taking 10 contracts. So for me here, the equation for it is, since I'm doing 10 contract, that's 10 times each point is going to be $5 times 25. So I took this trade here for a profit or risk of 1,250. I'm on a $150,000 account. So if we divide that by the number there, or sorry, wrong. 1250 divided by. So the risk is like less than 1%. So I'm typically risking very little to take this trade because I'm now in the funded account. So basically with my risk that I have here, I can lose 4 trades back to back. But since the win-loss ratio is pretty high, I think the win-loss ratio right now for this month is at, it's currently at 83% win-loss ratio. So in order for me to blow my account, to lose the account, I have to lose 4 times back to back. Previously, I was taking a bigger risk. I was taking a little bit over 1%. where I would have to lose more than 3 times back to back. But now that I'm on the funded accounts, I'm taking lesser risks. So I can build a foundation before I get to that point. But yeah, so this is one way of applying it. If you wanted to take it as a 1-to-1, which is an equal risk, or if you wanted to do it at a 1030, which would be the continuation. So say, for example, you wanted to apply this. This wasn't the first entry that came up. This was maybe the second entry. In a situation like this, then you could have taken it for a lower risk or yeah, lower risk because the win-loss ratio for this is a lot higher versus the 25-25. Does that make
I'm
sense?
sorry. No, looking at this chart, in the first green momentum indicator, the first one, the candle in there is red. That
Yes.
one. So based on the videos I've watched, I really shouldn't have taken a trade there because I should only take the trade if the candle matched the momentum indicator. But here it's the opposite. It's red in a green momentum indicator. So why was the trade taken?
Yeah, so the color of the candle actually doesn't matter. It's just the momentum. The color matters on the following one. So
Oh,
if
I
the
see. Okay, okay.
so with the momentum candle, you just want to, so basically the logic behind this is that when this here came, or let me go back a little bit. So if you were just following this candle by candle, when you see a momentum here, this doesn't necessarily mean that it's wrong. This would be considered an
Okay,
invalid momentum. But what you're looking for here is you're looking for the confirmation. So initially
okay.
for the double body or the double wick right here, because this is going
Yeah,
to that price is reversing. So like we talked about earlier with the higher highs and lower lows, this is indicating that, okay, there's a lower low or there's a lower low here, or we'll say this is a high, low, high. And then when you see this here, the double body, this is going to give you indication that, okay, price is now going to start going in the opposite way. So this is where the pieces come together because you understand the highs and the lows. And now we're using that as a confluence. So you have the first reversal pattern right here. And then now you're looking for confirmation. So you're looking for the buy signal here to indicate that, okay, momentum is now reversing to the upside. So
okay,
that's the first. That's the second step. First, you identify the reversal here, then you identify momentum, and now you're looking for confirmation. So this doesn't necessarily mean there's an entry here. It just tells you maybe look out for price to go in that direction. So now that we
okay,
have this here, this is okay. Now we get the confirmation. We have the reversal, momentum, and then this is the catalyst. So this is a catalyst
okay,
that's okay. Price is likely to keep pushing up from here. And
okay.
then you can see it from there. Price then pushes up from that point. So
Okay, so what kind of stop loss and take profit would you take in a trade like this? How do you what's the difference between a quick scalp and uh, a longer trade? Is it the time? Is it the 1 minute versus maybe 15 minutes or something like that?
So the difference between it is for the breakout, it would be the first one because that will indicate that, okay, this is the first push that can happen throughout the market. So the first one
Okay,
is going to be considered the breakout. That's the one that we take for the full move for the 25, 20.
okay,
And then every follow-up move, because the breakout has already happened, right? So usually this will happen earlier in the session. It will happen like, I think yesterday it happened at like very early. Let me go to Thursday. So Thursday made a lot more sense because it happened so early in comparison to, yeah. So I think our entry for Thursday was, it happened, see 6:30 right here. Oh yeah, so it happened immediately when when market opened. So market opened over here at 6:30.
okay,
So for the first one, that's the breakout. Um, the breakout would happen right there. So we have a double body rejection, that's a reversal. We have the momentum, we have the confirmation right here. This would be the initial entry.
okay,
For the initial entry, you'll see that the candles are moving very quickly and you're getting a bigger move, right? So you can see right there, it goes immediately straight to profit target. Now, every breakout V3 continuation. So you have to remember there's a continuation after because the breakout has already happened. Now we're looking for continuations of it. So at this point, now everything after this is going to be for the smaller target because the
Okay.
volatility is already done. So you can see over here, if you follow it closely, that these candles are big, so it's moving very quickly. But as price continues to move forward, you see how the candles here, they're getting smaller and smaller. So that's why you
Yeah.
change your risk because at this point, you're like, okay, I don't want to go for the full, and I'll put the sides next to each other. I don't
I
want to go for
see.
25
Okay.
points until the market is
Mm,
slow. So I only want to go for 10. See, it's a big difference because
okay.
you see how big these
Okay.
candles are. If you're going for this target, it's a long way to go. But if you go for this
Mm,
target, you're going to hit your target for sure.
yeah. Okay. Okay. So you say you prefer to go for the the trades immediately after the session starts and go big.
Yeah.
Okay.
Yeah, because the volatility is higher. So the candles are moving quick.
Yeah.
And then you'll see if you continue to move along, you'll see how the
Mm,
candles they start to get smaller and smaller. So like at that
yeah.
point, it becomes more difficult to catch trades because it just goes back and forth, right? And you're not going to
Yeah.
have here. Initially, the candle is moving very quickly up, quickly down. Now you see price goes like just sideways now.
It's just ranging.
Yeah.
Yeah.
Yeah, so
Okay.
that's how you can make the assumption of like what to use. But the market is always changing. So if you traded, say for example, you traded during COVID when like Trump was president, the
Mm-hmm.
volatility is crazy. Like all day the market is moving very quickly. So back then, that strategy you mentioned before, where you go for 100 or 1,000 pips, that's possible because back then the volatility is so high. If I draw 1,000 pips here now. Like, let me show you what 1,000 pips is. The market doesn't even move that much, right?
Mm-hmm.
Or the
Mm-hmm.
market moves
Mm-hmm.
quickly. Now you see 100 points is you're not going to get that. It's impossible. So
Mm,
we don't use those strategies anymore. The strategies still work, but we would have to
mm,
make the adjustment and make them smaller. So like now we're doing 25, 25. We make adjustments over the years. So sometimes you go for 25, 25. Like it's go through evolution of time. Like now we're doing 25, 25. During COVID, we were doing 150, 150. You see how this will
oh
never,
wow.
yeah,
Yeah.
that's why the numbers have changed. And you have to
Mm,
adapt with the market. A lot of people can't adapt with the market because they don't understand how the market changes. But you can see
mm,
it's changed a lot. Before we used to even do 50-50, even
mm,
50-50 is still pretty big to make your profit target. You hold on to that position for like, 30 minutes to an hour. At that point,
mm.
market shift. So now we do 25, 25 because that's currently what the market's giving us.
Okay.
Yeah. And then like you
Okay.
said, smaller scalps. It's almost what is going to hit. You're going for 10 points. There's even you can make a mistake. I've seen people, they make mistakes all the time. They take the trade too early, they take it too late, they take a trade that's not even there. And as
Mm-hmm.
long as you have 10 points, it's you can make any mistake here. The odds of you hitting your target will be likely. And that's why we
Okay.
number there because it's like a safeguard. It's just a safeguard so
Mm,
we hit, but
mm.
you're able to make mistakes at times.
Okay. And once you've taken your TP and once you've set your TP and your stop loss, can you adjust it while the trade is going on? If, for example, you feel you can actually get a higher profit, so can you adjust your take profit while the trade is going on?
Oh yeah, no, definitely. Yeah, you can. So if once you get to that point where you're able to analyze the market, like that's kind of what Kip did here. So Kip, what he'll do sometimes, and he mentioned that during the live session, is what he did initially was he would took the first entry here. He takes it as a pivot scalp. So normally, when you take a trade like this, the strategy that he likes to apply is called a pivot scalp. So when you have the pivots up, he looks for the buy signal, which is above. He initially took this trade as a pivot scalp 1030, right? If you're doing that smaller scalp trade, his initial analysis was, okay, I'm going to go for a small move. When he saw the candle go up, he's like, okay, I'm moving my stop loss higher because he said, okay, now at this point, this is turning into a breakout V3. So he initially was going to go for 10. And he's like, oh no, okay, there's a green candle, V1 pattern right here. And he's using the full analysis to identify, okay, there's a confluence here. So instead of going for just 10, he's now going for 50. So that's what he did, and he made big profit. That's why Kip here, if you look at his profits, he made 4,000 off that trade.
Oh,
See,
wow.
so you can
Yeah.
make once you get good, you can make those adjustments. But in the
Mm,
beginning, just follow the strategy as it's
mm,
supposed to be applied, and then in the future, once you're good at making your own analysis and identifying these confluences, you can make adjustments. Like you said, you can go for a higher profit target. You can even if you want to. So some people in the group who just let the trade run. Sometimes what they'll do is they'll just have no profit target, and once price moves up, they just move their stop loss in profit, and then say for example, this is their stop loss, and they just keep trailing it. So price goes up higher, they have no profit target, and as price continues to climb, they just move their stop loss higher
I
and higher.
see. Yeah.
And whenever it turns around like that, then okay, then they're out. So instead
Mm,
of getting out at 10, instead of getting out at 10 or instead of getting out at 25, they just keep climbing higher and higher and higher, and they get out at 50. And that's
mm,
why I created this indicator here, the trailing stop. And this is a little more advanced, but in the future, if it's something that you would like to use, the tool here is very, very useful. So
okay.
basically, this would work is so say for example, we have a buy signal right here, right? This is where the entry would come up. And if you want to just trail it, you would just put your stop loss at this green line down here. So basically, whenever this moves up higher, your stop loss is just trailing up.
I see. Yeah.
There's a lot of different ways to do this to basically
Mm,
maximize your profits, but it just depends on the person, right? Some people
mm,
don't have the patience or the discipline to follow. They get, once you're in profit, they get nervous. They're like, okay, I want to take my profit now. But once you've
mm,
been trading for years and years and years, you don't have that feeling anymore. You're no longer greedy. You kind of just want to just let it run and let it be. But everybody's different, so it's
mm.
up to preference.
Okay. Wow, a lot to take in.
Oh yeah,
Okay,
no,
so there are quite a few words I've heard you say that I would like you to explain. So there's the ATR, PRB, fake out, buy stop, break and close past. There was something you said today. Um,
here, let me make a
and
list.
then,
So
okay,
okay, so first one was
the
you want
ATR,
okay. ATR next was
PRB. Then something I hear you say a little, a bit is
Mhm.
fake out. And then there's a buy stop, and then knockout liquidity. And then I also want to know what FTMO means and Apex. I heard you say that FTMO and Apex.
Yeah, sure.
And then, yes, and then there's another one I think I heard you said break and close past the pivot or something like that, or reject off the pivot and reject off the session.
Split it, reject, pivot.
Reject off session.
So we'll do
And
break goes past I'll say structure.
break and close past structure. Yes.
Yeah,
Yes.
structure can mean a lot of things. So we'll do that. That makes sense. All right. Any other terms I should add to this?
No. Buy stop. I think you said something about buy stop.
I'll explain buy stop and sell stop. We'll do both of those. Those
Okay.
are the same thing, but in different directions. Okay,
Okay.
perfect. So ATR is short for average true range, and I'll put that here. So ATR basically will show you how the market is moving during a certain period. So you can see down here on the bottom, I have my ATR.
Yeah.
So ATR basically, depending on what your settings are, the default settings is 14 candles. So it'll give you the range, the average of the range within 14 candles. So say for example, right here, the previous 14 candles, which is 14 minutes, that kind of gives you an idea of how market's moving, within this time period over here. So the ATR just gives you basically a top-down look as to how to expect price to move moving forward. So in the past 14 candles, it shows 20 ATR. Once you've been on the live sessions long enough, you'll start to see that like you'll know what an average range is. Like you'll know where it should be and where it's moving fast or it's moving slow. Generally, if the market's moving kind of slowish, like normal but slow, it's 15. So 15 is like the number right now during this time period, where we're like, okay, if the number is around 15 and 17, then that's okay to take trades. When it goes above 20, 22, like, oh, you're thinking, okay, this is high, because what this is telling you is that each candle is moving about 20 points. So if you're using a TP stop loss, a TP stop loss of like, because some people like to use smaller TP stop loss, like something like 1025. If you're doing 1025 and then say, for example, the ATR is like 26 or 30, you can get stopped out in one candle. So like each candle, the average of it is the number down there. So if the ATR is too high, then that kind of gives you a hint like, okay, I shouldn't use a small stop loss. I should make a wider one. So instead of using, say a 1025, they'll move up to maybe a 1030, or in a different situation, maybe a 2550, because you understand that, okay, I need to have enough space here so that my trade can breathe and not get stopped out immediately.
Okay.
So that's what the ATR is. It's just a standpoint to understand like, okay, how is the market moving right now? Do I need to adjust my stop loss? Do I need to make it tighter? Do I need to make it wider? And then in the opposite, like say for example, the ATR is like 10 or 8. If the ATR is 10 or 8, then your stop loss is fine at like wherever. You can make it even tighter if you want. You don't have to have it so wide, because if your stop loss is like 30 points or 50 points and the ATR is 10, like say for example the ATR is very small, and say each candle is this small right here, you're going to be in that position for a long time, because it's not going to
Okay.
go up and down. So that's what the ATR is. It just gives you an understanding to see how volatility is, and if like you should adjust your TP stop loss to something
Oh,
bigger. To adjust.
okay. So the higher the ATR, the higher your TP stop loss should be,
Yeah, exactly.
because
Yeah.
each candle is okay. All right.
If the candle will be too big, and if it's too big, you
Yeah.
don't. Because sometimes this is what will happen with a lot of people. Say they enter a trade and say their TP stop loss is too close. See, like there's no entry here, but say for example, you were to take a trade there, it would hit your stop loss really quickly, but then
Yeah.
it's where it would hit your profit target. So
Yeah.
you just make adjustments based off, what the ATR is, make a
Okay.
bigger, tighter TP stop loss.
Okay.
Yeah. Okay, so that's it with the average range. For the PRB, there's no specific name for it. This is just a strategy that we apply. I'm not sure. Are you familiar with the strategy or not so much?
Not so much.
Yeah, so the PRB is one of the breakout strategies. It used to be one of the strategies that I used to apply. I used to do two breakouts. I would do the PRB, and then I would do the breakout V3, BV3. So those are the two strategies that I was applying. I still identify the entry because the strategy is still good. The only problem is that I can't take them anymore, because sometimes the PRB will be for a sell and sometimes the BV3 will be for a buy. And you can't have two trades running opposite directions. So you kind of have to choose one or the other. And for me personally, I like the BV3 because it's more stable and it's more structured compared to the PRB. The PRB is a little more it's more on the subjective side, because it depends on
Okay.
how people identify the entry. So the entry for today was over here. Yeah, so the entry for the PRB was over here. And so the way that the strategy works is, so the market opens here at 6:30, and you'll see it by it's kind of, this is actually a good example today, because someone mentioned it in the mentoring group, and they identified a different candle for the steps. So basically the first step that you're looking for after market opens is you're looking for the trend. You want to make sure that basically all of the pivots are above level 4. Level 4 is a red pivot here. So you can see earlier in the day, this was a bullish trend because you see all the pivots are above it, and this
Yeah.
indicates the trend is moving upwards.
Yeah.
Here on market open, the pivots were shifting back and forth. So there was no trend until right here when the pivot started to shift again. So you can see how the red pivot is below all the other ones. And this is going to indicate that, okay, the trend is now starting to go back up.
Yeah.
Uh, so the first step for the PRB, and this is going to be a little complicated because a lot of people get confused. This is another reason why I didn't want to make this the main strategy, because it's for more of an advanced trade, not advanced, but someone who understands how to read this, because you have to be very quick with this. So the first step is to look for price to push up in the direction of the trend. The trend here is bullish, so price pushed up. This candle right here came down. The first step is to look for price to pull back and reject off the pivots. So that's one of your questions. What's a rejection off a pivot? A rejection off is basically just identifying a candle wick. So the candle wick shows that price kind of bounces off these points. And that's what we would consider a rejection. So price comes up, comes back down. It doesn't exactly close below here and it pushes back up. So this would be a rejection. That's the first step. For the second step of the PRB, and this is where the confusion arises a lot, is where you look for what we call a space. I call it space because there's no real name for it, but it's basically consolidation. So a consolidation is basically price not really moving in either direction.
Okay.
Or so it is just going sideways. So this right here would be the step which we would call space, and price goes sideways because it doesn't really push past the previous candle, right? It stays in between. So this is where it kind of gets tricky because there could be two space here. Like this green candle could be space or this red candle could be space because both of them are not moving outside of the range. It's just going sideways. So the first step is the rejection off the pivot. The second step is space, which is consolidation. And the third step is another rejection. So basically the pattern that you're looking for here is you're looking for price to push up, come back down, reject, come back up and go sideways, reject again off here, and then go in the direction of the trend because we had the bullish trend here. So that's kind of the pattern you're looking for. Push up, retrace, sideways, retrace back, and then go in the direction of the trend. So you can see over here, we have that, right? We have price identify the trend here. It pushes up. This red candle retraces down. We have consolidation space right here. This candle right here comes back down to reject off the pivot on the bottom side. We don't care about the top here because the trend here is bullish. So we want to see the rejection bottom, and the top is irrelevant to us. So this right here would be the PRB entry. And you can see immediately on the next candle, it pushes straight to its profit target, and then it continues to climb higher.
Oh, that's a bit complex. I
Yeah,
think I prefer I prefer the other strategy.
Yeah, it's a little more complicated. This is why we
Yeah.
don't as much. Like at some point in the future, once you're able to follow the price action and how the price is moving, it'll make sense and it's a good strategy. But it's only good to people who are able to apply it properly because a lot of people make mistakes identifying it. They don't know how to identify consolidation because it's moving so fast. Like right here, it's easy because we're taking each candle at a time. But when the market is moving, this thing's moving fast, back and forth, and it's hard to read it unless you know what to look for. So
Okay, so if we had decided to use the BV3, we would have taken the trade just after the first green candle after the green momentum signal. In this particular, yes, that one.
So this here wouldn't be because there's no V1 pattern before it. The first step is to look for the V1 pattern before it.
Okay.
Yeah, so you're looking for the double body or the double wick. Remember
Okay, yes.
There was no body or double wick, so unfortunately there would be no entry here. But if there was a
isn't this a double body, the red and the green candle?
No, so the bodies would have to be on the same level. See how they're different?
Oh, I see. Okay.
It's a little slightly higher. But if they were on the same level, yes, you'd be 100% correct.
Okay.
Yeah.
Okay.
Which preferably this would be the entry that we would want it to take because it would happen right away, right?
Yes.
Yeah, that was not the entry because of there's no V1 pattern there.
Okay.
Yeah. So let's go back to your list here. Okay, so we went over the ATR, we went over the PRB.
Yes.
So now we'll go over the fake out. So let me see if I could find an example of, okay, so I think I could, all right. So let me just mark up structure here and I'll kind of show you. This doesn't really require much, but I'll show you here. Okay, so I drew structure here. Basically, where I draw structure is where the higher highs and the lower lows are. Typically, I don't really care about the 1 minute too much because you can see there's a lot of noise here, but we're just going to use this as an example. So the way that I would draw the structure here is I go back right here, and you'll typically see during the live session, I'll say, okay, price is now ranging, and then I'll say we want to watch out for the fake out below here as it pulls back in. So that's typically how the analysis would work. So I'll say something like this, like, okay, price is not going back and forth. And the reason why we were looking for the fake out down below was because from today we were looking at a bullish market. So the trend here was bullish. You can see from the pivots, it was
Yeah.
bullish. Down below was green. So we already knew, okay, if price comes down, this is probably going to just fake out. And that's where the term fake out comes out because
Okay.
what happens is they try to lure in traders because sometimes people want to catch the reversal here for price to come down and continue down.
Mm.
But what happens a
Mm.
lot, unless you're using the same analysis as us, because we use so many different points to identify, okay, where's the bias for today, like retail
Mm-hmm.
sentiment and fundamentals moving forward here. You can see like a normal person, they would see this, okay, price is breaking structure. And what happens with a lot of people is they get faked out. They go in
Yeah.
right. They're like, okay, I'll put my stop loss right here. And they'll try to,
Mm.
what happens next? Price goes down a little bit. It lures them in, right? Because people see this coming down. They're like, okay, this is going to come down. But
Mm.
realistically, this is a fake out. And we know it's a fake out because the retail sentiment today was so high for a buy. So you can see
Mm.
they get faked out and they lose the trade. So
I see. Mm.
by fakeouts. It works in both directions. So say, for example, price was bearish and it's moving
Mm.
out this way. If price was to push up here, we can look for the fake out right there too and pull back into here. So
Mm.
that's basically where we consider the fake outs. Whenever we draw structure for a support and resistance, basically on the outside, that's the thing that you want to look out for, fake outs. And then you'll see again when
Okay.
it comes back down.
Mm.
And then what happens here again? Same thing. They try to trick the same person to enter another
Mm.
sell. So the person doesn't
Mm.
get like, okay, I'll do it again. Like I got unlucky on that first try. So now they go again, get faked out again, and then it goes from here. We already know price is going up.
Mm.
And you can see right there, it pulls back into the range. And then
Mm.
see, now they get faked out both sides. They get
Mm.
faked out twice here. At this point, they lost 3 trades back to back. Now their account
Wow.
is, yeah.
Yeah. Yeah.
It's key. If you understand how to read the market, you'll know where the fake outs are happening because the
Mm.
market was changing today. So you could have lost in both directions. You could have taken sells
Mm.
here, you could have lost. You could have taken buys here, could have lost. So in this point, in this situation, we want to trade, within the range versus
Mm.
outside because you get faked out easily.
Yeah. Okay. I don't want you to go beyond your 1 hour because we have many more sessions coming. So we can actually do the rest at a later session
Okay.
because I think I gave you quite a few and it might just take you over the 1 hour. And maybe by the next class, I might have many more questions to ask.
No, definitely. And this is good because you're building your foundation and you're starting to understand stuff. The more that you understand these
Yeah.
little pieces, like you said, the basics of it, it'll start to make more and more sense and you'll start
Yeah.
to find the answers yourself in a lot of instances. And I think
Yes.
getting through the live sessions will help you a lot because it's the same thing every day. If you notice, it's the
Yeah.
same procedure, same routine,
Yeah.
nothing changes, and it just gets you better and better each day.
Yes. Yes. Definitely. This is just awesome. Okay, so I'll keep the remaining questions for the next session, and but between now and then, I'm going to continue on the courses the module, sorry. And maybe by then I would actually understand some of the things I've written down now that I don't understand. And then I would have new questions going forward. But just one more thing. Is the Dow Jones the only thing you trade at the moment?
Yeah, that's the only thing that I personally trade, but there's other people in the
Okay.
group. They also trade the NASDAQ. The NASDAQ
Okay.
is kind of tricky. So the NASDAQ,
Okay.
it's all tech stocks. So the thing with the NASDAQ is they're always switching out stocks that are within that
Okay.
in that index. So like sometimes, it's going to be very volatile. You're going to see a lot of crazy movements for NASDAQ. A lot of people who aren't prepared to trade the Dow, because the Dow is a little risky too, unless you know how to trade it. The smaller
Okay.
version of the Dow is the S&P. So the Dow has the top
Okay.
30 stocks in the US. The S&P has the top 500. So
Mm.
with those, it moves a little slower and it's a little cheaper to trade. But
Okay.
we've been trading the Dow Jones for so long that this is like what I'm really good at. So for me personally,
Okay.
this is what I trade. But other people in the group, they trade NASDAQ, which is NQ. They trade S&P, which is ES, and some people trade gold, which is very similar to NASDAQ. Those are all risky.
Okay.
What I recommend
Okay.
is just find one asset that you're good at and just get really good at that. So that's why I've been able to
Okay.
the Dow Jones.
Yeah.
Yeah.
Okay. Thank you so much, Sean. And thank you for taking so much time to teach me such basic things. But
Yeah, no worries. I've
yeah.
recorded these, so I'll give you the video too if you ever want to go and rewatch it. Every time we have a meeting,
Okay.
you want to go back and just replay it, and if you missed anything,
Okay.
it'll be helpful for you. So you can always just reiterate what we discussed and reinforce your knowledge.
It will be very helpful. Thank you.
Yeah, no, definitely.
Yes.
All right, Marion.
Okay. Thank you so much.
Okay, great.
Good,
Yeah, it's over
good
soon.
night.
Go for you.
Okay.